Okay, good afternoon and welcome back everyone to our options. Welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about time spreads, calendars, and diagonal spreads. These spreads are many times on the surface, sometimes a bit confusing for investors. So I want to spend a little bit of time breaking them down, calendars and diagonals, even though they are categorized in the same category, they're actually quite different in nature. So I want to kind of break down the difference between a calendar spread and a diagonal spread, what they're used for, and kind of what do they mimic, if you will, because I think many times when you get to time spreads, they get a little confusing. So I think it's important to kind of take the steps as to how do you progress towards a time spread, and that'll help you give you a better understanding as to how these are traded and why you should consider trading them. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So just a bit of housekeeping here today. We're talking about calendar and diagonal spreads, but tomorrow morning, we're doing our next thematic investment series. That's where we're going to talk about the future of food, looking at agriculture, looking at how food trends have changed in terms of food, how climate change affects our food sources, and the companies that affect that. We're all looking at that tomorrow morning. And then next Thursday, we're going to be doing a special educational session on the introduction to index options. We haven't done a lot on index options, so I want to provide some education around what are the benefits of trading index options? How are they different from ETF options? A lot of investors feel that they're very similar, but there are some substantial differences between index versus ETF options. So we want to highlight them and make sure that you understand that. So what we're going to do today is we're going to start off by talking about just a quick introduction to time spreads, the three different types of strategies: bullish strategies, bearish strategies, and neutral strategies. We'll start off by talking about neutral strategies because that's really where a calendar spread comes into play. We're going to talk a little bit about what type of neutral strategies you could trade, but the consequences of trading some of those neutral strategies and why you might want to consider using a calendar spread instead for a neutral strategy. Then we'll talk about bullish and bearish strategies by talking about diagonal spreads, which are useful when you have a mildly bullish or mildly bearish view. And then we'll talk a little bit about the optimal spreads for calendars and diagonals before we go through a few questions, before we go through a few examples, and then open this up for Q&A. But the primary question that I want to help investors walk away from today's session is an understanding as to how you can use options creatively, because this, when we talk about time spreads, this is really kind of where you start to stretch the limitations, if you will, of your creativity with respect to options, because at the core of your option strategies are four fundamental building blocks. You can buy a call, sell a call, buy a put, sell a put. All strategies are made up of these four fundamental building blocks. And when you talk about time spreads, you're really kind of pushing the envelope as to how you can create different structures with these four different strategies. So today is really talking about creativity. Time spreads, I think, are a very creative way to utilize options to give you unique payoff graphs that you can't really create any other way, but at the same time doing it in a way with limited risk, because there are other strategies that you can trade that have a substantially higher amount of risk, but we don't necessarily advocate for investors to trade those types of strategies. We want to talk about trading strategies that give you limited amounts of risk. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you how you can utilize these types of time spreads to take a neutral view, to take a mildly bullish, mildly bearish view. And it's specifically, it's a strategy that is used very heavily in earnings season. And that's exactly where we are right now. So hopefully this is a fairly timely session to help you, to give you a little bit more education around trading these types of time spreads. So when we talk about time spreads, there's really two types of time spreads we're talking about: calendars and diagonals. So to understand the two, there's really a segmentation between those. You have bullish and bearish strategies, and then you have neutral strategies. When we refer to bullish and bearish strategies, we usually think of a long call or a long put as our first fundamental building block of a bullish and bearish strategy. And But we know that when we buy a call or a put, there are plenty of challenges there because the cost of buying that call or the cost of buying that put, the stock needs to overcome that amount before the strategy is profitable. And that's pretty hard to do consistently over time. So one of the ways that we can offset some of that is by trading what many of you know as a debit vertical spread, a call debit spread for if you're bullish, a put debit spread for when you're bearish. And the call or put debit spread, what it does is it sells an option to offset the cost of the long option to reduce the risk, reduce the capital outlay, and improve your break-even costs so that the stock doesn't need to move as far in order for those strategies to be profitable. So when we talk about diagonal spreads, what we're really doing is we're pushing the envelope a little bit in terms of how much premium we can collect against a long call or a put that allows us to minimize the cost of that long call or put as much as possible, potentially even bringing down the cost of that call or put down to zero or perhaps even negative numbers if you can really find some unique opportunities here in the broader markets. But that's really how we gravitate from long call to debit spreads to diagonal spreads. That's what we're going to talk about here today. Now, when you have a neutral view on the market, this is really where we don't talk a lot about short straddles and short strangles because these are two strategies that have unlimited risk. And we generally never advocate investors to trade strategies that have unlimited risk. The same kind of risk that you have when you short a stock, as you've seen in GameStop, you can have some really substantial losses very, very quickly if you get this incorrect. So short straddles and short strangles, while giving you a truly neutral view on the markets, I generally don't advocate many investors to do that, especially for those of you that are new to options trading. If you have some experience trading, you may want to, trade those, or if you have a large account, you might want to trade those. But I advocate for investors who want to explore neutral strategies to take a look at calendar spreads, because calendar spreads give you the very similar risk profile to a short straddle or a short strangle, but you do so in a way with limited risk. And that's the key here, is to be able to take on a neutral view, but do so in a way with limited risk. So those are the three strategies we're going to explore here today: diagonal spreads and calendar spreads. So we're going to first talk about the calendar spread, the neutral strategy, and then we're going to talk about a long call diagonal spread. We're not going to cover a long put diagonal spread because if you understand calls, this is just the mirror image of it. So we're going to spend our time learning about call diagonal spreads, and you'll see how you can easily flip the mirror image to the put side. So when we talk about time spreads, like I said, the goal of a time spread is to push the envelope with taking advantage of the fact that different expiration dates have different implied volatilities and they decay at different rates. So this is really where you can be fairly creative, because we've seen this theta curve before, and theta tells you the speed at which the value of an option decays as for every day you hold on to that trade. So for example, if you hold on to a trade from 9 months to 6 months, during that time, you have a small amount of decay. From 6 months to 3 months, you have a larger amount of decay. And then from 3 months to 0 months, you have the most amount of decay. Now, this graph is not to scale, but it just gives you a sense for, depending on where on the time horizon you are with respect to your expirations, how much time decay do you incur on the option that you hold. And generally speaking, when you're buying, you want something with low time decay, because whatever you're buying, you don't want that value to decline very fast, or else that's going to eat away into your profits. On the flip side, if you're short an option, if you've sold an option, you want that time decay to be as fast as possible. The faster, the better. Now, that's why when you're buying, we always say that you want to buy somewhere up here, because that'll reduce the amount of time decay. And when you're selling, you want to sell something down here, because that increases that time decay for every day that you hold on to it. So when we talk about a debit spread or a credit spread, we're talking about buying and selling an option on the same expiration date. So yes, you get some of that short option versus long option, but you're doing it on the same expiration date. When we trade a time spread, What we're doing is we're trying to do the same thing that we generally do with the debit spread, which is offset the cost of that long call with a short call. Here, we're doing that same thing, but doing it across two different expirations and trying to maximize the differential between the option that we buy and the option that we sell. Because we want to buy something with very low amount of time decay, and we want to sell something with a very fast time decay. And hopefully the decline that we have in the short dated option offsets, if not actually has a positive time decay on the whole spread. Because when we're trading debit spread, we're still net short theta. When a time spread, sometimes you can actually get positive theta. So by buying an option, you're actually collecting premium. So this is really what we're doing when you're trading a time spread. So to understand it, let's first talk a little bit about a neutral strategy. And this is really where a short straddle comes into play. This is your most standard strategy, if you will, for a neutral strategy. It's a strategy that has limited reward with unlimited risk. So I'm going to use Facebook trading at $300 as an example. And let's say I sell a short straddle on Facebook because I think Facebook's not going to move from where it is. It's just going to stay around $300. I think it's fairly valued. It's made a big move. And I think it's going to consolidate for quite some time. So let's say, for example, I sell a 2-month $300 call for $16 and I sell a 2-month $300 put for $15. That collects a net credit of $31. Now, a short straddle is pretty simple to understand. You're basically short the call or a put at the exact same strike. And then whatever premium you collect, you're going to be able to take a trading range that's $31 around the $300 strike price. So you take the $300 strike price, you add $31, and that's your upper break-even price, which is $331. You take 300 minus $31, your lower break-even price is $269. So as long as Facebook stays between $269 and $331, this strategy will be profitable. And many investors, when they look at this type of strategy, they usually say, this sounds like a terrible idea to take on $31 of potential reward in exchange for unlimited risk. But the one thing you have to remember is that the price of the option is based on the expected range of the stock. Many times you can take the short straddle to estimate what is the market's implied probability of this particular expiration. So what that means is that there's about a 68% chance, generally speaking, this is a rough estimate, there's a 68% chance that Facebook will be between 269 and 331. That's what the at the money straddle is effectively telling you, is what is the market implying the stock is going to stay within. And if it does stay within that range, you're going to make upwards of $31 per share. The lower it goes, the less money you make. The higher it goes, the less money you make. And a lot of investors will say, who wants to take on unlimited risk? But you really have to consider how far the stock needs to go before you take on, let's say, $31 in losses. So your profit target here, your max profit is $31. But how far does the stock need to move in order for you to lose $31? The answer is roughly $362. It's $300 plus the 31 plus another 31. So the stock has to move above $362. That would be almost a 2 standard deviation move by the time that happens. And to the downside, that would be $238 to the downside. So Facebook would have to be below 238 or above 362 in order for you to lose $31. So that's the type of risk reward. So really what you realize when you short a straddle is that the stock needs to make a very, very large move in order for you to lose your potential reward on this trade. So those are some of the trade-offs that you're making. But it is truly one of the most efficient ways to take a neutral view on an underlying stock. But it does have unlimited risk. Technically, that's true. If Facebook, for whatever reason, it gets acquired by Apple tomorrow and shoots up to $500, you take on those losses as a short straddle. So a better strategy, in my opinion, similar strategy, not quite the same, but very similar risk profile, is trading a calendar spread. A calendar spread is made up of strategies that look nothing like a straddle. So here, I'm still going to use Facebook trading at $300. To construct a calendar spread, what I'm going to do is I'm going to first buy a $300 call option. Let's say it cost me $26 to buy. And then what I'm going to do is I'm going to sell a shorter dated option, a 2-month option at the same strike price. And let's say I collect $16. Now, what happens here is because I've paid more for the long call than I'm collecting on the short call, my net debit, meaning this trade is actually traded at a net debit of $10. So before in my short straddle, I'm collecting a $31 credit. That's the buffer that I effectively have. That's the buffer that I effectively have when I'm utilizing this type of strategy. Can everyone hear me? Please type yes into the chat window if you can hear me and see me. Okay, perfect. I don't know. I thought that there was an issue there. Okay, so the interesting thing about a calendar spread is that despite the fact that it has a risk profile very similar to a short straddle, it's actually traded at a debit. And what's interesting about a calendar spread is that the max risk is the debit of the calendar spread. So what this achieves is a risk profile very, 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 very similar to can everyone still hear me now, or is my audio still having some issues? Okay, looks like it's good now. All right, so like I said, what this calendar spread achieves is a risk profile very similar to shorting a straddle, but it's traded at a debit, and your max loss is the debit that you pay. So, and in this particular case, and I must have gotten cut off here, but this was about $325. And so when you trade a calendar like this, you still have a target price, a break-even price, very similar to a short straddle. It's not as wide as a short straddle. It's a little narrower than a short straddle, but in exchange for it, what you have is a risk profile that effectively then tapers off, and you have a defined risk here to the left side, and then you have the same defined risk to the right side, so that no matter what happens, you cannot lose more than the $10 that you pay for the calendar spread. Yet you have a profit potential that's between 275 and 325. Again, not as wide, because before we were talking about 269, and I think it was 331. So as you can see, it comes in about $6, but you reduce your risk here just to $10 per share. That, in my opinion, is a pretty good trade-off. So that's why whenever I have a neutral view on a stock, I much prefer trading a calendar spread than I would trading a short straddle, which gives me slightly better odds of success, but substantially worse outcomes if the stock makes an adverse move to the upside. Now, but the difference between calendar and diagonal spreads is that you still have to manage these trades at the first expiration. Because a short straddle at expiration, if the stock is below $300, the put is in the money. If it's above $300, the call is in the money. With the short calendar spread, you only have to worry about if the call is in the money. So you're really only concerned if the stock rallies substantially, because if it declines, then the short $300 call option that you've sold will expire worthless, and you simply just own the 5-month $300 call that you purchased. So at expiration, you have to determine whether Facebook is going to be above $300 or below $300 at the 2-month expiration of the first short option on your calendar spread. If it's above $300, you have to buy back the short dated call at a profit, and it depends on whether you still want to own your 6-month or your 5-month long dated call option, or if it's below $300, you effectively just own the 5-month call option, but you do have a potential loss on a big decline, meaning if the stock was to decline substantially, your risk is still limited to $10, but you do have losses here to the downside. So that's really how you want to think about a calendar spread. Is very similar to a straddle, but it gives you slightly, the odds of success are not as strong, but you're trading off unlimited risk for a defined amount of risk. So whenever you're thinking about a neutral strategy, next time you're thinking about trading a short straddle, consider taking a look at a calendar spread. But a calendar spread is, similar also in nature to, let's say, a poor man's cover call, because you're long call and then you're short a short dated call against that. You're just doing it at the same strike price. When you do it at the same strike price, you get this risk profile up to the first expiration that looks very similar to a short straddle. Now, once the short call expires worthless, or if you have to buy it back, well, you have the choice then of either just holding on to the 5-month call option because you think the stock is going to continue moving higher, or you can sell another 2-month call option. Maybe in this particular case, collect another 15, 16 bucks. And what happens is, you can see, if I collect $16 on the first $300 call option, what if I collect another $16 on my second $300 call option? Let's say the stock doesn't move, it stays around $300. And I sell another 2-month $300 call option. Now this whole trade turns into a net credit. What that effectively becomes is a trade that looks like this, where I can have no potential for losses because I've collected a net credit on a trade that looks like this. So this is really where you can start pushing the envelopes of these types of strategies. And there's so many variations that you can trade on this, but there are, this is just giving you an example of how you can use time spreads and lower the cost of a long call or a put, and effectively long-term owning that long call or put for zero cost, or potentially even negative cost, by trading short-dated options or selling short-dated options against your long-dated options. And as long as the time decay on the short legs exceed the time decay on the long legs, that's how you're going to be able to maximize these time spreads. So that's when you have a neutral view on a stock. What if you have a bullish or bearish view on that stock? And that's really where diagonals come in. So diagonals, like I said, it's built on the building blocks of a long call. So, we're all familiar with the long call. Let's say we have Apple that's currently trading at 130, and you think the stock's going to go higher. So let's say you want to buy a 6-month call option. A 6-month call option costs $13. That means your max risk is $13. Your max reward is unlimited, but your break-even price is $143 at expiration. The stock has to move up to $143 or higher before the strategy is profitable. That's not easy to do. So some of the things that we've learned is that we don't have to just buy a call option. We can sell another call option against it. Maybe we sell a 150 call against it, collect a little bit of premium, and maybe bring down the cost of this trade from $13 to maybe $10. And then what that does is it brings our break-even price from $143 to $140. And when you trade these debit spreads, what you're doing is you're trying to improve the odds a little by decreasing your risk, decreasing the break-even price, so that if the trade goes in the direction you expect it to, you have a higher return and you have a higher probability of profit because you've reduced that break-even cost. But with debit spreads, you can only go so far, meaning you can't reduce the cost of your long call by more than 20, 25%. That's usually the extent at which you're able to reduce the cost of that long call. So that's really where time spreads come in, because same thing, I'm bullish on Apple long-term, but in the short term, I think that there's a limit as to how much higher the stock can go. So if I buy a 6-month call option for $130, I can sell a 1-month $142 call option. And let's say I collect a $2 credit in exchange for that. Now my max risk is only $11. But in a debit spread, I can only do that once between now and the expiration of the long call. In a time spread, like a diagonal spread, because I'm selling a 1-month call option against the $13 debit, I can potentially do this multiple times before my 6-month option is over. So what I'm doing is I'm basically continuously collecting some premium to offset the cost of my long call. And because these short dated calls decay at a faster rate, what I'm collecting each month on the short call will largely offset any time decay I have on the long leg. So what you're going to see here is that you have a payoff graph that looks similar to a calendar spread, but it's skewed to the right because I'm not selling the at the money call, I'm selling an out of the money call. So I have some upside here, but this is really similar to a debit spread, where in a debit spread, if the stock goes substantially higher, I start to cut off my losses. I start to taper my potential gains. Just the difference here with the diagonal spread is that I do start to see some lower gains if the stock rallies substantially. So that's the risk that you take with trading a diagonal spread. But there are some significant advantages to trading a diagonal spread versus trading a debit spread. And that is the fact that over the short run, between the first month, during the first month, your net theta many times can actually be positive, meaning on a debit spread, if the stock doesn't move, you're going to have some losses. Not a whole lot, but you're going to have some losses. With the diagonal spread, if the stock doesn't move, you might actually see some actual gains because, again, that 1 month call option could decay faster than the 6 month call option. So maybe you collect $2 on the 1 month call, but on the 6 month call, you only lose $1.50 in time premium. That gives you a net credit of 50 cents. So even if the stock doesn't move, you are actually making profits. That's not something we're used to when we're buying an option. When we're buying a call, we're buying a debit spread, we know that we're going to have time premium that we're going to have to pay. A call diagonal can either mitigate most of that time decay, and occasionally it can even generate a net credit, a positive time decay. And the one thing that you have to pay attention to with a diagonal spread is you have to look at the width of the spread, which in this particular case is 130 to 142. That's a $12 wide diagonal spread. And you have to look at how much you're paying for that $12 wide diagonal spread. Because if you pay less than the width, then even if the stock rallies infinitely higher, you will not have any losses to the upside. But if, let's say, you pay more than the vertical width, what you do see is some losses to the downside, meaning it will actually start to see losses to the downside. So when you're trading a diagonal spread, I usually try to trade a diagonal spread where the debit that I'm paying is less than the vertical width, because that way, even if the stock was to rally substantially higher than I had expected to, I won't take any losses on that trade. I just simply will have not as high of a profit. So that's the trade-off that you're making here when you're trading a diagonal spread. Is, again, it's similar to trading a debit spread because it is a debit and you're basically long an option and you're short another option, out of money option against it. But by selling short dated options against it, over that 1 month holding period between now and the first expiration, you will many times have either net zero theta or potentially even positive theta, so that if the stock doesn't move, you don't see any losses. If it does move in the direction that you expect it to, mildly, you see some gains. But if the stock was to rally substantially, that's where you start to underperform here. So that's the trade-off that you're making here in exchange for either net neutral theta or a slightly positive theta. And at the end of the first month, you have the same, I would say, dilemma that you have when you sell a cover call. If the stock is above the strike price of the short call, you have to either buy it back or simply you're going to have to exercise your long call against it. And then if you're below that short strike, then you can let that call option expire worthless, and you can choose to sell another call option against it. Now, if your goal is to maintain your long-term bullish view on the stock, you want to keep selling calls against it, just out of the money call options, and keep collecting a premium. If you're able to collect $2 every single month against your $13 call option, 3 or 4 months later, you might be able to shave off, let's say, $8 of premium out of the $13 call option. So what you will end up effectively owning is a 6-month, $130 call option for a net debit of, let's say, just $5. That's the goal that you're generally shooting for when you're trading a diagonal spread, is you're simply just trying to continuously erode the cost of that long call, but selling short dated call against it, because over 4 months of selling a short dated call, you're going to collect more money than if you sold a 6-month call option against that by trading a debit spread. That's why I tend to find many investors will, and this is generally why I always tell investors, don't trade a debit spread that's 3, 4, 5, 6 months in expiration. If you're going to trade a 5 or 6 month debit spread, you're much better off turning that into a diagonal spread because it's going to allow you to collect more premium at a faster rate and really offset that time decay of that long call. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay, perfect. So now let's talk a little bit about what we consider as the optimal calendar spread. Generally speaking, you want to go out at least about 90 to 180 days in expiration for the long leg. And on the short leg, you would generally follow the same best practices that you would have if you were selling a cover call, somewhere between 30 to 60 days away. Short dated options, not too far out, not too far in, and you want to buy an at the money call or a put and sell an at the money call or a put. Now, you can skew this a little bit higher, a little bit lower if you do have a small directional view, right? So let's say Facebook is currently at $300 and you think the stock is going to drift up a little higher to 305 or 310, then you can sell that 305 or 310 call calendar spread. Or if you think it's going to drift down to, let's say, 295, you can sell the 295 put calendar spread, depending on which way you think the stock is going to drift a little. If the stock is just where it is at $300 and you think it's going to stay at $300, it doesn't really matter whether you trade the call debit spread or the put, the call calendar spread or the put calendar spread. But if you do think there's a bit of a drift here, as it goes higher, you're going to trade the call calendar spread. If you think it's going to drift a little lower, you want to sell the put credit spread, because you always want to sell an option that's out of the money. You don't want to sell an in the money option. So for those reasons, that's why, depending on the drift, the direction you expect on the drift, you want to sell the appropriate option for that. Now, this is a strategy that is best suited when the short dated volatility is higher than the longer dated volatility, because again, you're short the short volatility and you're long the long dated volatility. You would like to have those as opposite of each other as possible, so that you have that the possibility of that mean reversion. Now, this doesn't happen all the time. You generally only see this across earnings. So if, let's say, earnings are coming up in the next 3 weeks, then the short dated option will typically have a higher implied volatility than the long dated option. And that's really why this is a strategy that's very suitable for earnings, especially when you think the stock's not going to make a big move. You know, there's a lot of stocks that you just, you see that they don't move a whole lot on earnings. So especially bank stocks, some of the consumer staple stocks, but the short dated implied volatility is much higher than the long dated implied volatility. As long as you don't have a big move in the underlying stock, as they kind of normalize, you're taking advantage of that when you're trading a calendar spread. And then when you're trading a diagonal spread, you're doing the same expiration dates, 90 to 80 days, 90 to 180 days on the long side, 30 to 60 on the short side. The difference here is that you're going to buy an at the money call or a put, and then sell an out of the money call or put against it, usually about a 20 to 30 delta call or put. And this is same thing. Short dated volatility is higher than the longer dated volatility is the best scenario for this. Again, there's not too often that you see this unless earnings is coming up, but it's generally suitable for earnings when you have a mildly bullish or bearish outlook on the stock. This is a trade that we do a lot on CNBC and options action. So for those of you that follow us, you've probably seen us trade quite a few of these calendar and diagonal spreads. It's a strategy that we use a lot during earnings season because, again, that's really when you have that short dated option that trades at a substantially higher implied volatility than shorter dated options. So let's take a look at Facebook here. And with earnings, sometimes you can adjust the expiration dates a little shorter. So let's say Facebook currently trading at around $310. Maybe you think the stock is going to move modestly higher on earnings. So let's take a look at using a calendar spread here versus, let's say, buying a call option or a debit spread. So I'm gonna compare those three strategies, let's say, for Let's use a diagonal, sorry. Let's say I buy a July option and I sell a May option against it. Let's say I think the stock is going to move modestly higher, let's say to 310 or so. So I'm going to buy the July $300 call. I'm going to sell the May 310 calls against it for $7. So that is a net trade cost of $10.05. Remember, this is a calendar spread or a diagonal spread that's $10 wide. But I'm paying $10.05. I'm paying more than the width. That does mean if Facebook shoots up substantially, as it goes higher and higher and higher, eventually I'm going to have a loss, a very small loss, but I'm still going to have a loss. So this is really why diagonal spreads, not good for if you expect a big move in the opposite direction. But if you're expecting a mild move, that's really where they tend to shine. So let's say you think the stock is going to be mildly higher here by the, when does it report earnings? On April 28th. So let's say a few days after earnings. So as you can see here, here's what these trades look like. If let's say Facebook is mildly higher here, and I would say $309 is not considered just mildly high. It's probably a little bit higher because Facebook's actually at 296 here. So let's say I think it's going to go to, let's say 305. Whoops, wrong, 305. So if I think the stock's going to move modestly higher here by a few days after earnings, that's how you can see the calendar spread will give you a decent return here versus a call option, a 20% return versus a debit spread, 17% return. And this all comes down to the fact that these two strategies have a fair amount of time decay versus the diagonal spread will have smaller amounts of time decay. Let's just take a look at this. As you can see, the theta here is actually positive. It'll gain $8.86 on each day that I hold on to the calendar spread. Versus if I trade the call option, I lose $14 per day to theta. And the debit spread, I'm going to lose less, but I'm still going to lose money on this particular trade. I only lose $3.85. So that's really where, you know, the theta of the diagonal spread works in your favor. So even if the stock doesn't move, so notice how on 290, if the stock stays at 296, I'm going to gain on the diagonal spread just on theta versus the call option and the call spread. I will actually lose money. And I do also have to consider the fact that implied volatilities will come down on this. So the gains won't be as large, because implied volatilities won't stay that high after earnings. So as you can see here, I still have a small return, small profit, because I'm gaining $14 a day when I'm holding on to this diagonal spread, versus here I'm losing quite a bit in terms of both the call and the call spread. Just the call spread doesn't lose as much. So that's how you can take a look at a diagonal spread if you have a mildly bullish, mildly bearish view. And even if the stock doesn't move in the direction you expect it to and just stays put, you'll still be profitable or slightly profitable on that trade, versus if you outright bought a call or a put, you would actually see a loss. Now, if let's say we're looking at a trade that we're more neutral on, Apple reports earnings here in 6 days. Let's say you think Apple's just going to stick around this 131, 132 level, which I think is a perfectly reasonable view, given the fact that I think there's quite a bit of visibility into how Apple will likely perform. So let's say I'm taking a look at a short straddle. Apple's currently trading at 131.94. The Junes are trading in $5 increments. They're all trading in $5 increments. Okay, so let's look at the June 130. Let's call it the 130s. If they don't have the 132s and a halves. So let's just say we sell the straddle at 130. That's going to collect $12.45. That means my break even is between 117.55 and 142.55. Let's just put that on the chart here. 142.55 is up here, and 117.55 is down here. So those are my break-even points. As long as Apple stays in between these two levels, this straddle will be profitable. So that's a pretty big wide range, right? That's basically right near the top of the range and right near the bottom of the range. And many times we're right smack in the middle. Not a terrible time to short a straddle. And remember, when you short a straddle, you also have advantage of time decay working in your favor. So if let's say a few days after earnings. The stock stays put. Just on the volatility collapse alone, you're going to start to see some gains on your trade. So let's also then take a look at a calendar spread. I'm going to use the same. I'm going to buy the June and sell the Mays. I'm going to do the 130s as well. Whoops. 130. So notice how my break-even costs are not as great. So this is 117 and 142. This is now 122 and 138, just to put that into perspective. 138 is here, roughly, and 122.59 is down here. So slightly smaller range that I can be profitable in. Now keep in mind that this is also for the May expiration. So there's only 29 days to go versus this one I have 57 days to go. So you're not comparing apples to apples necessarily. Here, let me do this just so I can show you this using the May expiration. If I use the May 130 calls, as you can see, that's my new range. The two ranges are not too different from each other, 120.55 versus 122. So this one is actually $2 wider for May. And I've limited my risk here to just $150 a share, $150 a contract, or $1.50 per share, versus here I have unlimited risk. So that's why, again, when I have a neutral view, I much prefer using a strategy like a call calendar spread rather than a straddle. Now, I will say, because the strike price here is actually below the current price, I would probably instead use a put calendar spread, just to be clear. So as you can see, they're almost identical in terms of trading, almost identical in terms of risk, almost identical in terms of break-even prices. But because I sold the 130 put, that's out of the money. I don't want to sell a 130 call on a 130 on the call calendar, because that's already in the money. I want to sell something out of the money, reduce my probability of needing to buy back this put option in this particular case. So that's how you can utilize this tool to set up a calendar spread, compare it to a straddle, and use a P&L simulator and see how these strategies perform. Now, the thing about a calendar spread, unlike a straddle, is that you do have to wait a bit until expiration to see how these strategies work out. So those are some of the things that you have to pay attention to as you trade these. So at the first expiration date, which is May 21st, let's take a look at May 21st. That's really where I tend to maximize my profit if the stock is just around 130. That's where I have the maximum profit if Apple stays around 130 at expiration. If it starts to move substantially higher, I'll see a loss. If it starts to move substantially lower, I'll see a loss. I see my maximum return if it settles around 130. So that's how this strategy works here in terms of being able to understand a calendar spread, understand a diagonal spread, and using OptionsPlay to set these up and understand each one of these strategies. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of these types of strategies. And I know off the surface, they tend to be intimidating, confusing, but if you really think about understanding the fundamental building blocks and understanding how they're constructed, and think about the fact that you're really just combining a long dated call against a short dated call where you're trying to maximize the time decay. That's the best way to think about it. And once you can wrap your head around that, these strategies become a little easier to understand. So with that, thank you so much. At this point, what I'll do is I'll open this up for Q&A. We have both a chat window and a Q&A window here at the bottom of your screen. If you could please just type your questions into the Q&A window, I will try to answer your questions out of that. Are the OptionsPlay reports helpful in making calendar and diagonal plays? So the calendar and diagonal plays, you can use the straddle and strangle report for finding calendar and diagonal plays as well. But the calendar and diagonal plays are more, based on directional views that you have. The reports are all made for trades where you don't need to have a directional view. Even a neutral strategy is technically a directional view. You can use the straddle and strangle reports to find calendar trades, right? You basically, instead of trading the straddle, you trade the calendar. That is something that you can do. But also earnings is also another way to find calendar and diagonal plays. What is the optimal time before earnings to enter a calendar spread? It's usually the same with any other strategy, about 2 to 3 days before expiration. I'm sorry, 2 to 3 days before the earnings event. Can you defend a bad vertical trade with this strategy? For example, I have a vertical in Morgan Stanley that won't roll anymore, but I can roll just a short leg. I'm not sure what you mean by won't roll anymore, but you can roll just a short leg. Is it because it's so far out of the money that it has no more premium left? I'm generally not a big fan of quote unquote defending a bad trade. A bad trade is a bad trade. Let go of the bad trade. Move on to the next trade. Defending a bad trade is just throwing good money after bad money, hoping that you can turn a small loss into a not a small loss. And you can certainly spend your time focusing on that, but I think you're much better off, instead of focusing on that, focusing on your winners. Spend your time and efforts on your winners, because you can turn those winners into much bigger winners. The best scenario that you may have with defending a bad trade is maybe you turn it into less of a bad trade, but you can also turn it into a much worse trade. So for those reasons, I'm not a big fan of quote unquote defending bad trades. Regarding calendar spreads, this is why most stocks sell off after earnings, run up to take advantage of high IV prior to dropping off in earnings. High IV and running has nothing to do with each other. So this has nothing to do with stocks selling off after earnings. Stocks selling off after earnings, meaning expectations are too high and they didn't meet those expectations. What are exit strategies on calendars and diagonals? So these are debit spreads, type trades. So the rules for debit spreads are pretty straightforward. You cut losses at 50%, start taking profits at about 75 to 100% gain. So the rules for debit spreads are roughly the same, even if you're trading calendars and diagonals. Should you hold the short out of the money call option to expiration? I noticed that most of the expirations you send out are for vertical spreads. Do you plan to include these strategies in the future? So, we occasionally do send out calendars and diagonals, especially when I do them on earnings during CNBC. I don't trade a ton of calendars and diagonals, and partially it's because of the fact that if you do, you can get the magnitude wrong and end up losing money on the trade. So for example, if I did this and I got the directional view wrong, whoops, sorry, this is not what I wanted to do. If I traded something like this, whoops. I just tend to find that when I do these diagonals, many times I can get the directional view wrong. Get the directional view right. But if I get the magnitude wrong and the stock jumps higher than I expected to, that I end up taking a bigger loss. So it's not my favorite strategy to trade, but it is one that we have traded and the one that we have sent out to our customers. Are these low IV strategies? So this is not just high or low IV. This is where the front month is much higher than the back month. That's the type of strategy that's best suited in terms of IV. What is the repair on a calendar when the stock declines? So these are limited risk strategies. So there's really not much to repair. I mean, you define your risk on a calendar and diagonal spread. If it declines, you take loss at about 50% and you get out of the trade. This will be in the video bank, correct? Yes, Kenneth. All of our sessions are recorded and we make those recording available. How do I make understanding strategy graphs easier? These strategy graphs are pretty straightforward from the perspective of that's the stock price moving higher, that's the stock price moving lower, that's profit, and that's loss. It's a two-dimensional plane. If the stock goes higher, you make money. If the stock goes lower, you lose money. That's how you read these charts. I am new to OptionsPlay. What are the reports? The reports are in your education and resources section, which is at the top of your screen. And the different reports are at the bottom of the OptionsPlay hub. The OptionsPlay Hub gives you access to various reports, such as the At the Money Straddle Income Report. This is the report that I was referring to. This scans the market for opportunities based on where we find the highest amount of premium that you're collecting for a straddle and a strangle. So for example, if I sold a Pinterest $70 straddle right now, I'm collecting $14 on a $72 stock. That's roughly 19% of the stock's value. Now this is report earnings in a few days, but IV rank, as you can see here, is pretty high, 37%. Snapchat, $57 stock. If I sold the $57 strike, that's an 18% of the premium that are collecting. IV rank of 44%. Snapchat does report earnings, if I'm not mistaken today. Twitter, same thing next week. So here's how you can find some opportunities. Caesars trading at $94. Currently, if you sold a $94 straddle, you'll collect $14.35, which is 15% of the stock price or 53% rank. Earnings are not for another 12 days. So these are some opportunities that you can trade calendars on by selling a calendar or trading a calendar instead of selling an at the money straddle. Steve, can you look at an ideal calendar spread on AT&T or Ford? Let's take a look at AT&T. I mean, I think AT&T is kind of the best stock for trading this stuff, where you would go long a June option, sell May $31 call option. AT&T just reported earnings today. That's how a calendar or diagonal would look like on AT&T. What about taking profit on a leg over 75% or closing a leg at 50% loss? So that's exactly what you would still do with the diagonal spread. Can you put on a calendar trade into earnings about 10 days out and then close a trade right before earnings to capture Vega? So Ken, you can, but then you have 10 days of exposure there to Delta, to Theta. I don't know that you want to do it 10 days in advance, because then you just have a lot of exposure that you don't need. If you're trying to just capture Vega, enter it right before earnings and close it right after earnings. How to choose calendars and diagonals for earnings trades? Jeff, I think that's what the whole webinar today was meant to show you, is trading calendars and diagonals for, depending on whether you're neutral or slightly bullish or slightly bearish on the trade, trading either a calendar or a diagonal spread. I like calendar call spreads. Could you share why they have high score? They have high score because that's what the probabilities say. The probabilities say that, the reason that the straddles have the highest score is because, the straddle is effectively telling you what is the implied move of the stock. So when you sell a May 31.5 straddle and it tells you it's $1.12, well, that's roughly what the one standard deviation move of the straddle is. So as long as the stock stays within the one standard deviation move, you have roughly no losses. That's why the straddle is one of the most efficient trades to make, or one of the most profitable trades to make. But just not a very popular strategy because you have unlimited risk. Instead, you can trade a calendar, you can trade a diagonal spread, which is actually, in my opinion, a better way to take advantage of that neutral view. It's just that you're not always able to find exactly the expiration date and strike price that you're looking for. So for example, AT&T, the stock is pretty, it's a low price stock. So even $1 apart is 3% away. So you can't quite find the exact diagonal that you want to mimic the straddle. So not always are you able to find a calendar or diagonal that mimics the straddle, but the straddle is one of the most profitable trades that you can make, because as long as the market gets the direction, the the implied move correct, which over a long period of time, the market does. It actually overstates the expected move. That's why short straddle is one of the most profitable strategies. It's just, again, not very popular because it has unlimited risk. I'm assuming your OptionsPlay web page is current, but mine is not showing the same data as yours. Bill, I'm curious to see what yours shows because as far as I know, everyone is seeing the same data. How come you can come up with a credit spread trace in the Excel report? I know you look for at least 33% of the width, but couldn't any stock or strike get that percentage of the width or better by adjusting to the other strikes? So Daniel, it's not about finding 33% of the width. It's about finding 33% of the width with a net delta of 25 deltas, because you still want delta exposure. I mean, just collecting, you can always collect more than 33% of the width, but it's not about collecting 33% of the width. It's about collecting, it's about getting a net delta of about 25 deltas so that you're still net long and still collecting 33% of the width. That is hard to find. And that's what our credit spread report does. And that's why out of the thousands and thousands of symbols you can trade, we narrow it down to just about a handful every single hour. In a call calendar, what if the call you sell becomes assigned, or do you want to get out prior to expiration? So generally speaking, the rules here is not, it's okay if you get assigned prior to expiration. First of all, you have the long call or put against it that you can exercise to offset that obligation, or you can simply just exit it. Generally speaking, you do want to try to get out of these before expiration. Tony, can you please try to clarify just a bit more what you said about buying out of the money option with a diagonal, why and what that looks like? Because you've got us pretty well trained to buy in the money when doing normal spreads. Oh, I was just saying that when you're trading a diagonal spread, if you think it's going to slightly drift higher, you want to do a call calendar. If you think it's going to slightly drift lower, you want to sell we want to buy a put calendar. So you're buying really an at the money call. I wouldn't call it necessarily an out of the money call. I'm just saying that here, if you think that AT&T is going to drift up to $32, you can trade the $32 call calendar, or you can trade the $32 put calendar. They're going to be identical. But the difference here is that when you sell a $32 put, this put option is already in the money. So that's why if you think it's going to drift a little higher, trade the call option. So you're buying the $32 call option. From my perspective, a $32 call option here is pretty much at the money, not out of the money. But then if you think it's going to drift a little lower, let's say you think it's going to drift down to 30, then in this particular case, you want to trade the put calendar spread because you want to sell the $30 put that's out of the money. You don't want to sell a $30 call option that's in the money, even though the two strategies are identical. Mark, I know that we're working on a bunch of, a few accounts that have had some problems with accessing the hub. Please be patient and send us another email at, through this process. Questions, ask us here at the top of your screen. I'll look into your account again, but I know we're working through some accounts that are having some issues. I apologize if you're having issues. Here's the thing is that everything in the hub, we can give you access like outside of the hub as well. So just send us an email and we'll look into that for you. But we are working on fixing a few accounts that are having some issues. What do you think about a buy ride on an equity 2 years out? So you should never sell an option 2 years from expiration because what you care about is not how much premium you collect. What you care about is how much premium you collect per day, right? Income is measured not in how much you collect, but how fast are you collecting it. So that's why yield is always measured in annualized terms, right? You want to compare, AT&T's dividend of 52 cents may be nothing, but it's 52 cents on a $31 stock per year. That's a 7% yield. You always want to think about the time component of yield. And so when you go 2 years out, the amount of premium that you collect per day is next to nothing. So for example, if I sold a May $32 call option, I'm collecting 78 cents per day. Not a whole lot, but it's also a pretty low price stock. But if let's say I sold a 2 year option I sold the same $32 call option. Here I'm collecting 7 cents a day. So one, I'm collecting substantially more than a long dated option. So what you want to care about is how much premium you collect per day, not how much premium you're collecting in total. Because if you collect more per day, guess what? You're going to be able to collect more premium over a long period of time. So a 30-day option has 10 times the decay than a 2-year option. So you're effectively going to collect 10 times the premium by selling 1-month options month after month after month over the next 2 years than you would if you sold a single 2-year option. That's how big of a disparity it is. That's why you should never, ever, ever sell long dated options greater than 60 days out. Because if you're selling anything greater than 60 days out, you're always going to make more money selling 1-month options multiple times than you are going to sell that 3-4 month option. And when you go out to 2 years, you're just stretching that even further. With the diagonal, do you let the short option expire worthless or roll before expiring? We usually roll it before expiration. We usually maybe even take off the entire trade before expiration, especially if it goes in the directional view that we expect it to. Are there more possible positive outcomes in a credit spread or a diagonal? I'm not sure what you mean by there are more possible positive outcomes. You know, both of these are directional plays and you need the direction to move in your favor. And that's the really only possible positive outcome, in my opinion. For diagonal spreads, how about buying the long call, then selling the short call when the underlying goes up, like leg in? So Ying, you can do that, but you have the risk of, instead of the stock going up, the stock going down. And now you've risked more money by just buying the long leg and not selling the short leg. So, you know, I would say that at the end of the day, it probably balances each other out, where sometimes you get it right and you're able to leg in and make a higher return. And other times you get it wrong and you leg in and you actually lose more money. Can these strategies work for 2 directions? Example, make money when the stock is neutral and bullish, or neutral and bearish. So that's what a diagonal spread is. A diagonal spread will make money if it's neutral, not much money, but it will make some money. And then if you get the directional view right, you'll make more money. Would you mind explaining once again the 2 break-evens? I mean, there's not a whole lot to explain. I mean, basically you have losses to either side. So if the stock makes a big move to the upside, you lose money. If the stock makes a big move to the downside, you lose money. And as long as it stays in the middle, you will be profitable. And the break-evens, the platform will calculate for you the 2 break-even prices. So as long as the stock is in between those 2 prices, you'll be profitable. In spreads, can we close one leg and keep another leg as it's in the money? You can, but again, you have the risk that if you close one leg, you're left with the other leg. You're completely changing the strategy. As long as you're comfortable with that risk and you understand the risk that you're taking with breaking apart a strategy, there's nothing wrong with that. It's just that generally speaking, it's rare that you're going to have you're not going to see some substantial outperformance by legging in and out of a spread, is what I'm trying to say. Is that sometimes it works out, other times it doesn't. And I think largely over time, the two kind of cancel each other out. So you're just kind of making it more complex, more complicated, adding transaction costs without necessarily having a lot of performance to show for it. Why is Lam Research down despite blowout numbers? Well, I've been on this call since I have not taken a look at that, but I think for the same reasons I'm short Intel on this earnings report is because I think that expectations are too high this earnings season. And even when stocks have blowout quarters, like, the stocks will still decline, like Morgan Stanley. On a diagonal spread, if you were able to make more premium by selling 2 2-week options back to back instead of 1 4-week option, should you do that? Marcus, you can take that to an extreme, but when you sell 1-week options, you have higher gamma risk. So I tend to find that 1-month options is about as short as I'll go. Even 2-week options have too high of a gamma risk. So yes, you have faster time decay, but that is offset by the gamma risk that you're taking. So anything under 30 days, I tend to find that that's where the two cross over. What criteria does OptionsPlay select spread width and strikes? When are you referring to debit or credit spreads, or which spread are you referring to when you say spread width? Actually, let me just take that back. Spread width is all, when we select our strike prices, the only thing we look at to select our strike prices are deltas. That's it. We never look at spread width. We never try to collect $10 or pay $10. We never look at it from a dollar amount, because a $30 stock is going to be different from a $300 stock. That's why you never want to use a fixed dollar amount. You always want to use delta. Delta not only accounts for the price of the stock, it also accounts for volatility. And that's really what you want to, that's what we really want to care about. And, when we trade options, we want to gain consistency. The only way you can gain consistency is if you choose your strike prices based on probabilities. And that's exactly what delta does, because delta is an approximation of that strike price being in the money at expiration. That's what delta tells you. So when you use delta to select your strike prices, every single time use the same deltas, then you're going to expect roughly the same outcomes every single time from a probabilities perspective. That's how you can gain consistency in your trading. If you randomly choose strike prices this time versus that time, sometimes you select strike prices that are 10% out of the money, other times you use 5% out of the money, you're going to see inconsistent results, because that's not based on probabilities. The only way to select strike prices based on probabilities is using delta. For debit spreads, you recommend buying back the short call when the underlying drops. So again, Ying, same point about your previous question about legging in and out. You can, but you're just adding complexity, adding more transaction costs, and half the time it'll work out in your favor, and the other half of the time it'll probably work out against you. So you will roughly come out the same whether you do it or not, but you add complexity and you add transaction cost to your trade. Are you ever afraid of being assigned before expiration date? Eric, you always have that risk of being assigned early. That's always the case, but that's usually why we try to close out these short legs about 2 weeks from expiration. Because if you close out a short leg 2 weeks from expiration, your risk of being assigned early is pretty small. Only problem I have with Hub is I've signed in again to access panel. Yeah, JQ, we're working on that so that we have a single sign on. So when you click on this in the future, it'll automatically log you into the Hub. That is coming. Can you view unusual options activity in your platform? We also do have that in our Hub. You can go to unusual volume report. You can see which stocks are currently reporting unusual volume. We actually sort it based on liquidity, and we sort it based on which symbols have the most amount of unusual activity. So for example, Dish Network today, substantially higher than usual calls and puts on, calls and puts for Dish Network, 936% of average volume on calls, 598% average volume on puts. And you can see what is the expiration date and strike price that generated the most amount of volume on today's trade. What percentage of the stock price should you sell a straddle? There isn't a hard and fast rule on that, Joseph, because it all depends on the volatility of the stock. Something that's not very volatile, maybe as low as 7-8%. Something that's very volatile, maybe something as high as 15%. There's no hard and fast rule on that. What is the color coding on the straddle report, and how do you best use to pick your plays? So the, first of all, it's sorted based on how much premium you collect based on the stock price. The higher the amount of premium you collect, the more of the bigger of the further away the break-even costs are. The IV rank just tells you the implied volatility rank. The higher the IV rank, the ones that are in red, so that I can quickly, see which ones have really high IV rank and focus on the ones that are most red. Because when you're selling straddles, you generally want to sell it in environments that are relatively high IV rank. So I would gravitate towards stocks like Caesars, especially if I have a neutral view on Caesars going into earnings. Caesars Strangle as well. Snapchat and Twitter also, Snapchat reports earning already, so this is too late for Snapchat, but Twitter is still feasible. Can you repeat what view determines the choice of a diagonal versus calendar? It all comes down to the directional view. If you think the stock's not going to move, sell a calendar. If you think the stock's going to make a move, a bullish or bearish move, trade a diagonal. Does it depend on one's view of the extent an earnings release will impact the movement of the underlying stock? Yes, Edmund, that's the only thing that matters, is your belief as how much of the earnings will impact the movement of the stock. I know how options play select strikes and spreads using delta, correct? Yes. So again, Julie, to your previous question, always use delta to select your strike prices. Every single strategy we teach you, we talk about the optimal deltas. Use that delta guide for your strike price selection. Can you use leaps for calendar spreads? Yes, you can. Absolutely. Eric, why are my questions not being answered? I think I've answered your previous questions, Eric. Would you recommend double diagonal over earnings trades? I'll be honest, I've never traded a double diagonal. A double diagonal is kind of like, I guess it's sort of, I don't even know if we have a double diagonal. We do. I don't know when anyone would ever trade a double diagonal, to be perfectly honest. You can, I mean, you're really just taking a call diagonal and a put diagonal and trading them both at the same time. I guess if you think the stock could move higher or could move lower, but you're not sure which way, but then if the stock makes a big move higher or big move lower, you lose money. You know, I just find this type of strategy kind of silly, to be perfectly honest. I don't know when I actually think that the stock will either move exactly here or exactly there. And I'm sure that it's not going to go here or here. So it's one of those strategies that this is kind of where you push the envelopes of creativity and what you can construct with options. But I just think that this is kind of where it just gets a little silly. Any plans to make it possible to initiate trades directly from the various reports? So we are actually working, and this is actually going to be coming out in a couple of weeks, where you can literally click on a symbol within the straddle report or any of the reports, and it will actually construct the strategy for you in OptionsPlay. So that is already in flight, in the works, and we are actually in the works of testing that. So hopefully in a couple of weeks, we'll be able to release that out for a few of the reports. I'm sorry, we're gonna start with the cover call, the short put, and the credit spread report. Once that's released, we're gonna do more on different reports. When you say you're looking for net delta of $25 in a credit spread, does that mean that the delta lower is 25 is suboptimal than higher than the 25 delta is suboptimal? Is it? Yes, I would say that that's true, because the optimal deltas is selling an at the money put. So let's say I'm selling the 31.5 put and buying back the 25 delta with the 30 puts. Now, AT&T is such a low price stock, so it's hard to find exactly the ones. Let's use Facebook for example. You know, the optimal debit spread is 45 days to expiration. So that would be the June 4th expiration. If I sold the 300 puts, let's say the 297.5 puts, because the strike price is, the stock has moved a little bit after hours, 275. That is your optimal deltas in terms of a credit spread. And if this collects 33% of the width, then you're good to go. But it's not very often that you're going to be able to sell these specific deltas and get, it's not even just having a net delta of 25. It's being able to sell the 50 delta and buying back the 25 delta, having those deltas and having collecting 1/3 of the width is what you're trying to find. Mitchell, yeah. But when I went to OptionsPlay, the same strikes would sell. Mitchell, so I think what you're confusing are two different strategies. You're confusing the debit and the credit spread. So Yes, the debit spread may have the same strikes as the credit spread, but that's a bearish trade. Um, so you want to sell the put credit spread. So that's a completely separate trade. So if I would sell the 1100 and buy back the, oh, they don't, that's weird. They don't have export. Those are the only strike prices for June 4th. I wouldn't do the 890s. I would do the 990s. I think you were comparing a put debit spread to a call put credit spread. Those are two very different strategies. So you want to take the strike prices from the credit spread report. That's what you want to take. Tony, I'll take a look at those reports that you're referring to and see if we can add that. Okay, with that, that covers what I can finish answering for today's session. Thank you so much for your time here today. I really hope that you guys are able to take advantage of what you've learned here today for your trading. Calendars and diagonal spreads are not always easy to understand. They take a bit of understanding of the fundamental building blocks, but that's why I always encourage investors, take the time, learn the fundamental building blocks. If you do that, these more advanced strategies will become more and more easier to understand, especially time spreads are probably as complex as they get with respect to the complexity of option strategies. So don't be afraid if this is your first time looking at these strategies, you're still a little confused. I highly recommend you to go back to your education, look at buying versus selling options. That when we talk about those building blocks, take the time to learn that. Once you do that, these more complex strategies, they'll all make more sense. With that, thank you so much. Have a great trading day, and I'll see you guys tomorrow morning on our next thematic investment series. This is for those of you that are longer term investors looking for long-term, bullish opportunities in the broader markets. Tomorrow, we're going to be looking at the future of food because climate change and globalization has had a huge impact on our food supply chain. It's important to understand what that means, especially with climate change coming, and what type of companies are positioned to grow within that particular space. With that, thank you so much, and I'll see you guys tomorrow morning.